Hello students, welcome to EPG Pathshala. I am Ritesh Verma from Maharaja Agrasen College, University of Delhi. Today we are going to talk on module Double Entry System from paper Accounting and Financial Analysis. Learning objectives. After studying the module, students may be able to understand the meaning of double entry system, its features and history. The understanding on the debit-credit rules might be deepened, along with the procedure in the record maintenance and some of the advantages of double-entry bookkeeping. Introduction. Every incorporated business is involved in the continuous business of sale and purchase of goods and services and works for the purpose of earning the profits, attracting the customers, and thereby satisfying them. They deal with the monetary transactions, those which are capable of being measured in terms of money throughout the accounting year. This dealing with the transactions affects the business in two ways. Something is increased and something is deduced or deducted from the business. This way, two-way effect needs to be recorded carefully in order to get a complete and clear image of the financial position of the enterprise at the end of the year. The recording of the transactions is done in a systematic and chronological order in the books of accounts, be it journal, ledger, or trial balance. The entire process of recording the transactions in the books of accounts is termed as bookkeeping. It is clear that this recorded data is of no use unless and until it is communicated to the interested users within time. The process of analyzing the data and communicating or presenting it in the form of organized information to the management is termed as accounting. The data is presented in the form of final accounts, which includes the summary of the entire working of the enterprise in quantitative terms. The aim of final accounts is to give a complete image of the enterprise, and this complete picture is possible only if two-way effect of each transaction is highlighted in the accounts, that is debit effect and the credit effect. By this way, the final accounts will be considered correct as well as complete.
Double entry system. Dual concept is the basis of accounting equation. Under this concept, the total assets are always equal to the total equities. Double entry system is a system under which each transaction is regarded to have two-fold aspects, and both the aspects are recorded to obtain complete record of dealings. Double entry system of bookkeeping adheres to the rule that for each transaction, the debit amount must be equal to credit amount. That is why this system is called double entry system.
History of double entry system. Accounting enjoys a remarkable history. Accounting is believed to be started in Babylonia and Egypt around 4000 BC, where the transactions were recorded on the clay tablets. As far as the history of double entry bookkeeping is concerned, the first ever mention of it was done in a book named Summa de Arithmetica, Geometria, Proportion and Proportionality, written by Luca Pacioli in the year 1494. In this book, along with the explanation to business and bookkeeping, the use of accounting terms such as debit and credit were made. Debit and credit is a very popular term which we use in accounting terms. Pacioli mentioned that all entries have to be double entry. It means that if one creditor is made, it becomes important to make one debtor as well. Debit. It is derived from an Italian word debito, which is further derived from Latin word debita and debio, which means owned to the proprietor. Credit. Credit is derived from Italian word credito, further derived from Latin word credo, which means trust, belief on the owner. Quick revision. Business transactions can be recorded in the books of accounts in two ways: single entry system and double entry system. Double entry system means a double effect of a transaction on the business. It means that every debit have a corresponding credit with an equal amount. Double entry system is used only in nominal ledger accounts. The first ever mention of double entry system was done in a book named Summa de Arithmetica Geometria Proportion et Proportionality, written by Luca Pacioli in the year 1494.
Debit and credit rules. In order to maintain a record of transactions in the books of accounts, an accountant uses various rules in order to show the two-way effect of the transaction. The rules of debit and credit can be classified into two heads under the double entry system: traditional approach and modern approach. The double effect of the transaction on the books of accounts remains the same, irrespective of which type of approach is being used by the accountant. Traditional approach. As per the traditional approach, the accounts are divided into real, personal, and nominal accounts. First, real account. Real account refers to the accounts relating to the assets and liabilities. Second, personal account. Personal account refers to the accounts of persons or organizations with whom the business deals with. For example, accounts of debtors and creditors. Number 3. Nominal accounts. Nominal accounts means the accounts dealing with revenue, expenses, losses, and gains. If an accountant uses the traditional approach to record the transactions in the books of account, then the following golden rule must be followed in case of different accounts. In case of real account, debit what comes in and credit what goes out. In case of personal account, debit the receiver and credit the giver. In case of nominal account, debit all expenses and losses, credit all incomes and gains. For example, transactions are classified as different accounts, and also either an increase or decrease are shown respectively. For example, transactions of salary paid. Accounts which are concerned here are salary account, which is a nominal account, and cash account, which is a real account. So debit and credit rule in case of salary paid will be debit all expenses and losses and credit what goes out. Second, transaction. Dividend received. Accounts which are related here are dividend account and cash account. Dividend account is a nominal account, cash account is a real account. In case of nominal account, credit all incomes and gains, and in case of real account, debit what comes in. Transaction number 3, machine purchased. Accounts which are related: machine account, which is a real account. So in this case, debit what comes in. And second account which is involved is cash account, which is a real account again. So credit what goes out. Modern accounting equation approach. In order to follow this approach, the transaction is recorded keeping in mind the accounting equation, that is assets is equal to liabilities plus capital. For this purpose, the accounts are divided into 5 heads: assets, liabilities, capital, expenses and losses, and income or gains. An increase in assets, losses, and decrease in capital, gains, liabilities means debit. On the other hand, a decrease in assets, losses, and an increase in capital, gains, liability leads to a credit. The following rules are summarized below. In case of increase, assets are debited, liabilities are credited, capital is again credited, income and gain is also credited, and expenses and losses are debited. In case of decrease, assets are credited, liabilities are debited, capital again debited, income or gain debited, expense or losses credited. For example, Mohan started a business with a cash balance of rupees 10 lakhs. In this statement, the effect of transaction would be a cash increase as well as capital increase. An increase in cash and asset would lead to debit, whereas an increase in capital results into a credit. Therefore, the transaction would be recorded in the journal with rupees 10 lakhs as follows. Cash account debit rupees 10 lakhs. To Mohan's capital account rupees 10 lakh, being cash brought in the business. Second, purchased machinery for rupees 6 lakhs and paid the amount in the form of a check. According to the above statement, no cash is involved. The effect of transaction would be increase in machinery and asset by rupees 6 lakhs and a simultaneous decrease in bank balance, which is an asset by equal amount. An increase in asset means debit, whereas a decrease in asset means credit. The journal entry for the same would be furniture account debit rupees 6 lakhs to bank account rupees 6 lakh. In summary, we'll write being furniture purchased and paid in check. Next, quick revision. The rules of debit and credit can be classified into two heads under the double entry system: traditional approach and modern approach. The double effect of the transaction on the books of accounts remains the same, irrespective of which type of approach is being used by the accountant. As per the traditional approach, the accounts are divided into real, personal, and nominal. Under the accounting equation approach, the accounts are divided into five heads: assets, liability, capital, expenses/losses, and income/gains. Maintaining accounts under double entry system. It is clear that every transaction carried out by business have a dual effect on the business, debit and credit with the same amount. This debit and credit of the account are presented in the form of a T account. T account is an individual account depicting the increase or decrease in that particular account only. It is prepared horizontally with debit on the left side whereas credit on the right side. The difference between the two sides is known as the account balance. The preparation of T account is just a one single step from a sequence of steps involved in preparing a full-fledged financial statement. However, it provides a simple way of record keeping to the accountant. There is a proper procedure to be followed in order to record the transactions and show the dual effect of the transaction.
Analyzing the source documents. The first step is to analyze the documents with respect to each transaction. Before recording the transactions, it is the responsibility of the person recording the transactions to check for the evidence proof for the transaction, either in the form of invoice or bank statement, thereby fulfilling the objective evidence concept. Recording in journal. The next step is the preparation of journal, also known as book of original entry. It maintains a chronological record of all the monetary transactions which took place in an accounting year. Posting from journal to ledger. After preparing the journal, a ledger account is maintained where the information about all records is kept. A ledger account shows the two-side effect of each transaction. For example, all the information regarding the increase and decrease in cash is recorded under the ledger to update the cash accounts. Preparation of trial balance. A trial balance shows a list of all the accounts with their respective balances. All the ledger accounts are listed in the trial balance with their amounts and are totaled up so that the sum total of debit equal the sum total of credit. Such information helps in the preparation of the final accounts. Preparation of financial statements. After the preparation of trial balance and cross-checking that the debit and credit totals are equal, the final step includes the preparation of final accounts, which helps in predicting the financial position, solvency, and effective working of any enterprise.
Features of double entry system. Transaction takes place only if there are two parties, one party receiving the benefit and other party giving or parting with the benefit. Each party is affected in opposite direction but with the same amount. Each transaction affects at least two items in an accounting equation. Changes are recorded in two related accounts in the books of accounts. Each account has two sides, left and right. For each transaction, debit amount is equal to the credit amount. Changes are recognized from the angle of the party in whose books recording is being done. The famous proverb, "Every debit has a corresponding credit," and vice versa, is based on this system. Business transactions are recorded in two different ways. First, single entry, second, double entry. Now, single entry. It is incomplete system of recording business transactions. The business organization maintains only cash book and personal account of debtors and creditors. So the complete recording of transactions cannot be made and trial balance cannot be prepared. Double entry. It is a system of bookkeeping and refers to a system of accounting under which both the aspects, that is, debit and credit transactions, are recorded in the accounts involved. The individual record of a person or thing or an item of income or an expense is called an account. Steps involved in double entry system. Preparation of journal. Journal is called the book of original entry. It records the effects of all transactions for the first time. Here, the job of recording takes place. Preparation of ledger. Ledger is a collection of all accounts used by a business. Here, the grouping of accounts is performed. Journal is posted to ledger. The balance preparation. Summarizing, it is a summary of ledger balances prepared in the form of a list. Preparation of final accounts. At the end of the accounting period, to know the achievements of the organization and its financial state of affairs, the final accounts are prepared. Example: from the following transactions of Messrs. Malice and Brothers, prepare a journal, post the entries in ledger accounts. Date: August 5, year 2014. Details: business started with cash. Amount rupees 5 lakhs. August 8, opening of bank account with PNB, rupees 1 lakhs. August 10, goods brought on credit by XYZ Limited, rupees 80,000. August 15, purchased furniture and payment done by check, rupees 90,000. August 20, cash sales, rupees 20,000. August 22, rent paid by check, rupees 28,000. August 25, goods sold on credit to ABC Limited, rupees 50,000. August 27, cash paid to XYZ Limited, rupees 80,000. August 29, check received by ABC Limited, rupees 50,000. August 31, salary paid in cash, rupees 30,000. Now solution to this problem. First, recording the transactions in a journal. Journal. Date column, August 5. In particular column, cash account debit, rupees 5 lakhs to capital account, rupees 5 lakhs. In summary, we'll write business started with cash. August 8. Bank account debit, rupees 1 lakh. To cash account, rupees 1 lakh. Summary, opening a bank account. August 10. Purchases account debit, rupees 80,000. To XYZ Limited, rupees 80,000. Summary, goods brought on credit. August 15. Office furniture account debit, 90,000. To bank account, rupees 90,000. Summary, office furniture purchased. August 20, cash account debit, rupees 20,000. To sales account, rupees 20,000. Summary, goods sold on cash. August 22, rent account debit, rupees 28,000. To bank account, rupees 28,000. Summary, rent paid by check. August 25, ABC Limited account debit, rupees 50,000. To sales account, rupees 50,000. Summary, goods sold on credit. August 27, XYZ Limited account debit, rupees 80,000. To cash account, rupees 80,000. Summary, cash paid to XYZ Limited. August 29, bank account debit, rupees 50,000. To ABC Limited, rupees 50,000. Summary, payment received by ABC Limited. August 31, salary account debit, rupees 30,000. To cash account, rupees 30,000. Summary, salaries paid. Total of debit and credit side of journal account is rupees 10,28,000 on both sides. Now second, posting the transactions in the ledger book. Cash account. Debit side of cash account. Capital, rupees 5 lakhs. Now credit side, August 8, bank, 1 lakh. Debit side, August 20, sales, 20,000. August 27, credit side, XYZ Limited, rupees 80,000. August 31, on credit side, salary, rupees 30,000. Capital account, credit side, August 5, cash rupees 5 lakhs. Bank account August 8, on debit side, cash 1 lakh. Credit side August 15, office furniture rupees 90,000. Credit side August 22, rent 28,500. Purchases account debit side August 10, XYZ Limited rupees 80,000. XYZ Limited account date August 10. Credit side XYZ Limited rupees 80,000. Now August 27, debit side cash rupees 80,000. Next, office furniture account debit side bank rupees 90,000. Now next, rent account debit side August 22, bank rupees 28,000. Next account ABC Limited debit side date August 28, sales rupees 50,000. Credit side August 29, bank rupees 50,000. Next, sales account credit side August 20, cash amount rupees 20,000. Credit side August 25, particulars ABC Limited amount rupees 50,000. Next, salary account debit side August 31, particulars cash. On debit side we'll write amount rupees 30,000. Advantages of double entry system. Scientific system. This system is the only scientific system of recording business transactions in a set of accounting records. It helps to attain the objective of accounting, complete record of transactions. This system maintains a complete record of all business transactions. A check on the accuracy of accounts. By use of this system, the accuracy of accounting book can be established through a device called a trial balance. Ascertainment of profit or loss. The profit earned or loss suffered during a period can be ascertained together with details by the preparation of profit and loss account. Knowledge of the financial position of the business. The financial position of the firm can be ascertained at the end of each period through the preparation of balance sheet. Full details for purpose of control. This system permits accounts to be prepared or kept in as much detail as necessary and therefore affords significant information for the purpose of control, etc. Comparative study is possible. Results of one year may be compared with those of the previous year, and reasons for the change may be ascertained. Helps management in decision making. The management may be also to obtain good information for its work, especially for making decisions. No scope for fraud. The firm is saved from frauds and misappropriations since full information about all assets and liabilities will be available.
So students, let us summarize what we have learned in this module. Business houses deal with the transactions throughout the year which affects the business in two ways. This two-way effect needs to be recorded carefully in order to get a complete and clear image of the financial position of the enterprise at the end of the year. Two ways means a dual effect of the transaction, debit and credit effect. The double entry system means a double effect of a transaction on the business. It means that every debit have a corresponding credit with an equal amount. As far as the history of double entry bookkeeping is concerned, the first ever mention of it was done in a book named Summa de Arithmetica, Geometria, Proportion and Proportionality, written by Luca Pacioli in the year 1494. In order to keep the record of transactions, certain rules of debit and credit need to be followed. The rules of debit and credit can be classified into two heads under the double entry system: traditional approach and modern approach. The double effect of the transaction on the books of accounts remains the same, irrespective of which type of approach is being used by the accountant. As per the traditional approach, the accounts are divided into real, personal, and nominal. And under the accounting equation approach, the accounts are divided into five heads: assets, liabilities, capital, expenses and losses, and income and gains. In order to keep a record of financial transactions showing dual effect, a proper procedure needs to be followed. That is, preparing a ledger account, posting the balances to the ledger account, and then preparing a trial balance, hence depicting the accuracy of ledger accounts. The double entry system is systematic in nature, scientific, accurate, and helps in ascertaining the true profit and loss balances of an enterprise. Thank you.